What's up, everybody? Jaspreet Singh here, and President Biden has just signed the $437 billion Inflation Reduction Act into law. And what I want to do today is go over the 5 main things that the Inflation Reduction Act does. And then I'm going to go over how these things will actually affect inflation, whether they will help inflation or make inflation worse. So you want to make sure you watch this video until the end because I'm going to give you a full summary. So the 5 main areas that the Inflation Reduction Act affects us, the economy and the world, the country, is 1, climate change. 2nd is corporate taxes. 3rd, prescription drugs. 4th, IRS and Irs Reforms and IRS auditing. And 5th, the Affordable Care Act. So let me go down this list. First, when it comes to climate change, the bill has a number of different credits and reforms in the climate change side of things, trying to push for green energy. So what are those things? It includes a lot of investments in climate protection, including tax credits for people and households that are using green energy. And this is a $369 billion provision in the climate change side. So almost $400 billion going towards pushing more green energy. 2nd is changing corporate taxes. So this bill aims at companies like Amazon, where Amazon earns a lot of money, billions of dollars a year, and then they can use the tax code legally to pay sometimes nothing in taxes. And so what this bill is doing is it's enacting a 15% corporate minimum tax rate on all corporations that are earning a minimum of $1 billion a year. And the second part of that provision is they're also enacting an excise tax on corporations that do stock buybacks. It's a 1% excise tax if a corporation does a stock buyback. So the way that you could think of that is almost like a sales tax. Like when you go to the store and you buy something, you got to pay your sales tax. Well, if a corporation spends, say, $1 billion buying back their own stock, they have to spend 1% in giving money to the government for doing share buybacks. So for investors, not so good news, but they're saying that it's too small of an amount to really affect share buybacks. So we'll see how that goes. 3rd has to do with prescription drugs and the prescription drug reform. And essentially what they're doing is this is targeting Medicare recipients. So if you are a recipient of Medicare, essentially you're getting assistance from the government to get health care, to get medications, to get prescription drugs. And what it's saying is, for one, Medicare recipients are going to have a $2,000 cap on out-of-pocket expenses. So if you are on Medicare, the maximum that you'll be paying out of pocket is $2,000. The rest will be paid for by the government. So that's the max that you can pay out of pocket. And it also includes provisions for the government to do more negotiating on the behalf of Medicare patients to negotiate the price of prescription medications. 4th, which is one of the most interesting for anyone interested in finance, is the IRS reforms. So this is an $80 billion provision where they are going to change the way the IRS works. The way that they're going to do that is currently there are 80,000 IRS workers and agents, and they want to hire another 87,000 IRS agents and workers. Now, to really understand what this means, this doesn't mean that 87,000 new IRS agents are going to be hired today. The way that the provision has framed it is over the course of 10 years that they're going to hire 87,000 new IRS workers. And the whole idea, according to the bill, is that over the next decade, about 50,000 or so IRS agents are scheduled to retire. So these 87,000 new workers are to replace those 50,000 or so people that are scheduled to retire and then stack the workforce. So it will be increasing the IRS workforce by almost 50% over the next decade. And their goal is to increase audits to get more money out of people and corporations who owe money to the government. Now, there's been a lot of talk that they're only going to be going after wealthy individuals. Well, a couple points that I want to make on that, because for one, They keep saying how they want to go after billionaires and wealthy people. Well, there are about 1,000 or so billionaires in the United States. Do you need an extra 10, 20, 30, 40,000 IRS agents to go after them? The answer is no. So who else are they going to go after? Well, rich people, people who are not billionaires, millionaires. But this is where you really have to go a little bit deeper than just beyond what people say, because people can lie with their mouths and do something else. Because the best way to predict what might be coming is to look in the past. And so if we look at 2021, the 50% of audits that happened in 2021 were on individuals or people, businesses, who made under $75,000 a year. So half of all audits in 2021 were on households, that's what it was, households making under $75,000 a year. So now when they start stacking the IRS workforce and invest more into audits, to invest more into making sure people pay their fair share, who are they going to be going after? Well, on one hand, you can say it's only going after wealthy people, it's only going after the rich. Well, why are they already doing half of their IRS audits on the middle class or people who are making under $75,000 a year? One answer might be, well, if you're making 50 grand a year, you probably don't have an army of accountants and attorneys there to defend you, so it's a little bit easier for the IRS to extract money out of you, versus if you're making millions. You're gonna have a team of people behind you that's ready to fight, that's documenting everything, that knows what to do, because you have the income to support that. So something to keep in mind with what's coming with the IRS and the Irs reforms. And one thing that I do want to mention, because this has been, I'm in LA right now, that's why you have the scenery. I've been doing a lot of interviews. And one topic that's been coming up a lot is this Irs reform. And the thing that I want to mention about this is really not a surprise, because we've had a lot of kind of foreshadowing of this. If you remember, over the last couple of years, we've had the government start to really track and get more information from cryptocurrency brokerages, because they want to be able to tax all those transactions. And then they also started to drill down onto apps like Venmo, where if you are transacting more than, I believe it was $600, if you do more than $600 of a transaction, that Venmo would have to report this to the IRS and the government. Well, why? This shows us, because now the IRS not only wants to enforce today's taxes, but they want to go back and enforce previous taxes to get their tax dollars. So that's something to be aware of. And number 5 is a change in the Affordable Care Act, where they are extending the subsidy for the Affordable Care Act. Essentially, the way that it works is, if through this Affordable Care Act, there are a lot of subsidies given to people that are funded by the federal government. So the government is essentially giving people money through the Affordable Care Act, so your medical costs are subsidized. This subsidy was going to expire in the end of 2022, and this Inflation Reduction Act is extending this until 2025. So it's extending the Affordable Care Act subsidies. Now, let's talk about what is actually going to happen in terms of reducing inflation and the cost, and what this looks like. Now, we did cover this in Market Briefs. Market Briefs is my free financial newsletter where every day my team is breaking down what's happening in the stock market, the real estate market, the crypto market, inflation, and the global economy. It's a fun newsletter. It's easy to read, even if you don't have any sort of financial background. We're breaking down everything that an investor needs to know about what's happening in the markets. That way you can stay aware, that way you can stay educated, and it only takes less than 5 minutes every morning. And the best part is that it is completely free. So if you have not joined Market Briefs yet, I'll put the link to how you can do it down in the description below. So now let's really dive in to the cost and what the numbers are going to look like. And this is not, I'm going to keep as unbiased as possible. I'm just going to talk about the numbers. I don't like to talk politics here. I'm just going to talk about what the numbers look like. So just understand that going in. So the goal is, this is stated from the White House, that the goal is to spend $437 billion through this Inflation Reduction Act. And their goal, by spending this $437 billion, is to raise $737 billion in additional revenue for the government. And that is now to cover some spending, also to help pay down some of their deficit. And they're saying that the biggest share of their revenue in this case is going to come from reductions in drug prices for Medicare recipients. And the second thing is tax hikes on corporations. So on the first part, drug price reductions, essentially giving Medicare, the government, more negotiating power to pay less money for prescription drugs. That's where they're hoping that they'll have less expenses. And then second, by enacting a tax on corporations, a 15% corporate minimum tax rate. Now, I'm not exactly sure how it's going to work yet. I've read through it. They haven't really fully laid out the details of how they're going to file or collect this 15% corporate minimum tax, because the reason why many corporations are paying, say, less money than 15% is because they have expenses that lessen their tax liability, right? You have your revenue minus your expenses equals your profit. Your profit is what is taxed. And so if you have revenue of, say, in this case, $1 billion, and your expenses are, let's say, $1.1 billion, and now you don't have any taxable income because you don't have a profit, you have a loss of $100 million. So you can't pay taxes when you're losing money. And this is what many corporations do, especially when you're in the startup stage, especially when you're in the early stages of a company, because now you're being funded by debt, you're being funded by investors, you're being funded by external money, not through your own. And what corporations like Amazon did is they lost money for many years, and so they would lose money, and now you'd pay no taxes because you're losing money. Well, once you start making a profit, now you might make, let's just say, $1 billion worth of profit. But then you can also say, yes, I made $1 billion worth of profit this year, but over the last couple of years, I lost $2 billion. So now you take your $1 billion worth of profit and you negate your previous years of losses. And now your tax liability this year, instead of paying taxes on $1 billion, is zero. So if you enact this 15% corporate minimum tax, what is this going to look like? We'll see. They haven't really fully laid it out yet. We'll see what will actually happen with that. The interesting thing is the 1% share buyback excise tax. So the argument here is by adding this quote unquote small 1% tax, that is not going to make that much of a difference, and that corporations are going to not affect or change their share buyback things that they do. They're just going to do it as normal. They're just going to pay a 1% tax. Now you have to think that they probably will do a 1% smaller share buyback, which might not seem like that big of a deal, but corporations do look at the financials pretty carefully. And if they have budgeted, say, $1 billion for share buybacks, well, they're not going to spend all billion on share buybacks. They will spend 99% of that on share buybacks and 1% of that for taxes. So 1% will probably not go to share buybacks. You'll probably have slightly smaller share buybacks, and most of it going to the share buyback. Now you might think, well, what's the big deal? 1%, what is that going to actually do? Well, yeah, maybe 1% isn't that much, but the question is really, where is this going to go? Because if we look back into the history of tax, when the 16th Amendment was first passed and enacted in 1913, the plan was to only tax the wealthy and the super rich. So back in 1913, when the 16th Amendment was passed, it was a 1% tax on anybody earning over $3,000 a year, and it was a 6% tax on anyone earning over $500,000 a year. This is back in 1913. What does that translate to today? Well, in today's dollars, that's a 1% tax on anyone earning over $90,000 a year, and it's a 6% tax on anyone earning over $15 million a year. So the goal was only to tax the wealthy because it was a 6% tax on only people making over 15 million, and then a 1% tax on anyone earning over $90,000 a year, which is the $3,000 back in 1913. Well, what happened? Tax rates went up. Nobody pays a 1% tax anymore, and the middle class is now bearing the biggest burden of taxes. They change. So the concern is, sure, maybe it's just a 1% share excise tax today, but what happens if they keep increasing that? Well, sure, you might say it's corporations that are going to pay it. Well, ultimately, yeah, it's the corporations that are paying it, but then that also affects people, because corporations aren't just this imaginary thing. They're made up of people and they're supported by people, because corporations are in business because people are spending there, and corporations are made up of people that work in the organization and that own the organization, the investors. And so if corporations feel like they need bigger profits in order to do these share buybacks, that means they're going to need more revenue, which means that they may have to charge higher prices. So these are the things that you have to be thinking about when it comes to higher taxes, because taxes are something that corporations have to think about, especially when they're thinking about their profit margins and things that they're going to do with the company. So just something to keep in mind. And then they also say that they're expecting to raise about $124 billion with a B from increased IRS enforcement. So what does that mean? That the IRS is going to have more agents to do more audits, to go after people who maybe did not pay the correct amount in taxes. And so they're hoping to raise another $124 billion to that. And so through all of these provisions, not only do they want to have this extra money, but they want to reduce the deficit by more than $300 billion in the course of a decade, 10 years. Now, there's a couple things that I want to go over, and then I'm going to go over which provisions actually increase and decrease inflation. Because a lot of this has to do with tax, right? Some of the biggest things that will help generate revenue is tax dollars, corporate tax dollars, taxes from going after audits to make sure people pay their share company buybacks. So they're predicting that corporations will continue to generate big profits that they can tax, that they can get this income. But what happens now if we don't see the same returns or the same growth in the economy that is being projected? Because we all know that the government, the IRS, and the Fed, everyone believes that our economy is very strong and that it's going to continue to grow year after year after year with really no downturn. I mean, it's been spoken many times that there's no downturn in sight. Well, if the government gets their money from corporations, the more money that people, the more money that corporations, the more money that investors make, the more taxes that the government gets, right? Because they tax your income, they tax your profits, they tax your salary. And so if people and businesses are making more money, the government makes more money through taxes. Well, if we do see any sort of economic slowdown, that means that incomes would go down, people would lose an income, and profits would go down. In which case, that means that the government would now be generating smaller tax dollars because, well, people are just making less money. So that's one concern, where they're hoping to generate a certain amount of money based off of their projections, but there's also a chance that the projections could be wrong. And in that case, now you're spending more money, but not generating as much dollars as you wanted. And if you're spending more, well, then that can also increase inflation. So that's the first concern. The second concern is also in terms of their cost projections, because the reality is many times the government hasn't been very efficient or good at projecting costs or managing costs. And many times what has happened, and you can look at really any example, when the government projects that they're going to spend, say, $10 billion on something, it ends up costing many multiples of that because they don't always know how to project or enforce or manage their costs in an effective way. And so while they say that this plan is going to cost $437 billion, there's a chance that it could cost significantly more than that. So you have the cost side and then the income side. There's a chance that the cost could cost a lot more. Sure, it could also cost less, but it's more likely to cost more just based off of the track record of the government. And then on the revenue side, there is a chance that they're not going to generate as much money as they predict. Now, the amount of money that they're predicting is probably best case scenario. They're not going to say a conservative number, say, we're hoping that we'll generate this, but we're going to plan to generate a whole lot more. No, they want to create a program that's going to look great to sell the provision, right? Because when you're trying to sell something, you're going to always talk about the best things, the best possible scenario, because that's how you're going to get the signatures to pass the bill. So the best case scenario is that they're going to raise $737 billion. But what happens if the economy slows down and they don't actually generate that revenue? Well, now you could potentially have higher costs and not enough revenue. And remember, what causes inflation? Inflation, by definition, is when you are inflating the monetary supply. When you're increasing the monetary supply, increasing the amount of money, the amount of dollars out there without increasing the amount of wealth, that causes inflation because now the buying power of a dollar is going down, causing the price of things to go up. That's what inflation is. And so if we go through these provisions, the climate change provision, none of this is, again, I'm just going to go through completely honest through the definition of inflation, what is going to cause inflation, what's not causing inflation. I'm not saying what's good, what's bad. I just want to say what causes inflation and what doesn't, because the name of this bill is the Inflation Reduction Act. So let's just focus on the name and what's actually happening. So under the climate change provision, the goal here is to invest money into more things for climate change. So it is a spending provision, not a reduction provision. So if the government is just spending more money, that causes more inflation. So the climate change aspect where they're spending $369 billion, the goal here is to spend money, invest money, and offer tax credits, meaning less revenue for the government, to improve the climate. Now, nothing wrong with wanting to improve the climate, having a green environment. I mean, we all live on the earth. We want to take care of the earth, but that doesn't reduce inflation. It might help the earth. It might help create green energy. Does not reduce inflation. So that's one. Second is the corporate minimum tax and share buybacks. That does reduce inflation because now the government will have more revenue to reduce their national debt, to reduce their deficit, to help pay that off. If the money is used to do that, that can help reduce inflation. The prescription drug reform, this one is kind of iffy on whether it will actually reduce inflation or not, because on one hand, they're saying that they're going to be able to negotiate the price of prescription medication down. If they're spending less money on drugs, then yeah, that reduces inflation because now you're spending less money on the government side. If you can spend less money, that reduces inflation. But on the flip side, they're also saying that Medicare recipients will have a $2,000 cap on annual out-of-pocket expenses. So if Medicare recipients have a $2,000 cap, that means that the government will cover any costs above that, right? Because somebody has to pay for it. And in this case, it is the government because Medicare is government funded. And so if the government is now going to take on more costs for Medicare patients, that increases inflation because now the government is spending more money. So kind of you could go either way on this one, depending on what actually happens. But it looks like if the government's going to be spending more, that will increase inflation. Fourth has to do with the IRS enforcement. So their goal here is to spend the $80 billion to hire more IRS agents and to invest more money into IRS infrastructure to hopefully generate more dollars. Now, most likely, you think that they're going to be able to generate that money back. If they can't generate that money through higher net worth corporations and businesses, they're going to go after middle-class Americans because middle-class Americans are easier to go after when it comes to an audit because you just don't have the same ability to defend and fight the way that a millionaire or a billionaire does because they're going to have an army. And so if you're going to audit somebody who's has all that support around them, it's going to be extremely difficult to extract that money because they know what they're doing versus someone who's making 20, 30, 40, 50 grand a year might not have that same level of expertise and the same level of defense. So it's much easier for the IRS to go after them. So the IRS enforcement will probably reduce inflation because their goal is going to be to generate more dollars in their spending. And then the fifth one is the Affordable Care Act subsidy extension, which is now where the government is going to be continuing to subsidize medical premiums through the Affordable Care Act. What does that mean? That the federal government is going to continue to spend money to keep medical costs low for people under the Affordable Care Act. What does that mean? More spending, more inflation. So there are some provisions here that will help reduce inflation, but there's also provisions that will help increase inflation. So just understanding, while the title might be Inflation Reduction Act, the goal of the provision isn't just to reduce inflation. There are other things. So I'm not saying what's good or bad. What I'm trying to say is understanding what causes inflation, what doesn't cause inflation. That way you can be more financially educated, because this is where sometimes you put or you put lipstick on a pig and you call it a, I don't know, what does it say? You put lipstick on a pig and you call it a duck? I don't know. But you're trying to, mask what's happening by calling it something else. So just understanding that, hey, inflation is separate than here, and inflation is a separate fight than what the government is doing. And if the government is printing more money, that's not going to help the inflation problem, because the inflation problem is its own thing. Climate change is its own thing. The Affordable Care Act is its own thing. Medicare is its own thing. And inflation is going to take time before it sees more of a drop, and it's going to take more effort by the Federal Reserve Bank and the government. So don't expect inflation to magically come down to 2%. Now that this bill is passed, there's much more that's going to happen. We keep you updated on Market Briefs, my free financial newsletter. So if you haven't joined Market Briefs yet, I'll put the link for you down in the description below. You have to grow your income, because now what happens to a lot of people is you get stuck in this mindset of trying to squeeze every penny out of your pie. You're making 40 grand a year, and now you're putting aside 25%. You're putting aside $10,000 a year for your investments and your savings. Remember, your income minus your expenses equal your investments plus your savings.